A recent rise in stock splits among large companies has some investors fired up. Although the splitting of a stock has no impact on corporate size or profitability, it allows investors to buy and sell shares more easily. Just last month, Amazon said its stock would undergo a 20-to-1 split on June 6th, and Tesla is also making a similar decision. Joining us now to give us the latest updates and advice on investing in stock splits is Brendan Caldwell, Director of Caldwell Securities Ltd. Brendan, welcome back to Forum Daily.
Thank you, Nima. It's been too long.
Too long indeed. Definitely, Brendan. So for those who are not familiar, can you go over what exactly a stock split is and why companies decide to split their stocks in the first place?
All right. Well, just first things first. A stock is or share is a ownership in the company. You have the ability to participate in the company's earnings and dividends to the extent that you own a share or multiple shares in a company. Doing a stock split just means that if you had one share before the split, you'll have 2 or 3 or 5 or 10 shares post-split. And at least in theory, the shares would be worth whatever fraction of the pre-split value they were. So as you said at the introduction, it doesn't actually increase the value of the company, it just increases the number of shares. And your one share, as I say, becomes 2 or 10, depending on the number of shares that are split into. I think you used the example of Amazon, one share is being split into 20. There are reasons for that, but we can get into that.
So what about reverse splits, Brendan? We know General Electric did that last year. What happens to the stock in that case, and why do they reverse in the first place?
Well, they do a reverse split. That is where you have, let's say you have 10 shares and they make it 1. Or I think in General Electric's case, if you had 8 shares, they make that just 1 share. So in theory, the stock is supposed to go up. So if a share is worth $1, if you do an 8-for-1 split, it now should be worth $8 if all other things are equal, because you had 1 share worth, or you had 8 shares worth $1 a piece. Now you have 1 share worth $8 a piece. At least that's the theory. In the case of General Electric, if I'm not wrong, I think stock's down nearly 20% since last year, though. So why is that? Well, it might be one of 2 things. One, companies that are doing share consolidations or reverse splits, however you want to phrase it, probably aren't doing that well, because if a stock is going up and up and up and up, you'd be more like Amazon and Tesla. You'd be looking at splitting them into multiple shares. But if the stock's doing poorly, it's going down and down and down. The reason you do it is twofold. Stocks to be eligible for margin, that is for people to borrow against their shares, need to be at a certain price. Also, particularly in the US, to be eligible for listing on certain exchanges, you need to be the stock needs to be above a certain price. So there are fewer people that will buy a stock that's not marginable, and it will cost more for them to buy it if it's not marginable. So that's one reason to do it. And there's a risk of being delisted if your shares price falls below a different level. Again, mostly a US thing for the latter point. But I think as we're seeing with the General Electric example, if you see a share consolidation, it psychologically does something to, and the shares tend to revert to their old price. Now, I don't know that GE is going to fall by, 8-to-1 or 1-to-8, but as we can see, it's down something like 20% since they did the split last year.
All right, Brendan, a minute and a half left here, but in terms of timing, is there an ideal time for investors to purchase a stock, maybe pre-split or following this stock split?
Well, in as much as share consolidations, I don't say they make the stock go down, but they're indicative of issues at the company, and there's the psychological aspect where the share price just tends to gravitate lower. So too, when a company's doing a stock split, like a Tesla and Amazon's, companies that are very strong, then you're more likely to see those stocks continue to do well. Does it matter that much if you purchase a stock pre-split or post? Probably not. But I think my inclination, if you're wanting to buy the stock anyway for reasonable fundamental or technical reasons, pre-split is probably best, because there is this tendency for the stock to gravitate back to the price that it was before, this time on the upside rather than the downside. So if you had to pick, I would suggest buying pre-split.
Always an informative interview, Brendan. Thank you again for joining us today on Forum Daily.
Thank you, Nima.